Today, turn and turn about. Welcome to the Property Imperative Weekly to the 4th of May 2019. Hello again, I'm Martin North, the Principal Analyst at Digital Finance Analytics. Welcome to our latest Property and Finance Digest to the 4th of May 2019. This week, we look at the latest from the Fed, finance sector results here in Australia, and the latest on home prices. And it's been another busy week. But before we start, a quick reminder that you can support our work using PayPal to make a one-off donation. Here is the link. Or use Patreon, where you can subscribe on a monthly basis and also access some additional material. Your support is greatly appreciated and it helps us to continue to make great content, and the links are in the comments below. We should start with the US news this week. The Fed held their rate, now some were expecting a cut of course, and as a result markets eased back while bond yields rose. The Fed underscored the patient approach ahead, but also a willingness to look through low inflation in the near term. Powell said interest rates are in a good place and hinted at low odds of any near-term changes. Now that seemed to disappoint some investors who might have been hoping for more stimulus in the near future, and stocks fell. Besides not endorsing any immediate case for a rate cut, Powell called low inflation transitory. The market didn't seem to know what to make of that. To use the word transitory a few times and in a few different ways. Transitory language might mean less probability of a rate cut, perhaps. As stocks lost ground, volatility picked up. The VIX, thought of as markets' fear index, jumped from under 13 earlier this week to above 16 at times on Thursday. And the VIX action on Thursday might serve as a reminder to investors of just how skittish this market is. But the volatility index was down 10.75% on Friday to 1287. Then the US jobs growth out on Friday surged in April, with 263,000 new positions created. That was well above expectations, suggesting perhaps that the US economy is firing on most cylinders. It looks like stocks could get a lift from the data after 2 days of Fed-related struggle. Analysts had been expecting jobs growth of closer to 200,000. And Friday's number was up from a revised 189,000 in March, which puts memories of the weak February data further back in the rearview mirror. As job growth accelerated, the unemployment rate fell to a near 50-year low of 3.6%. You have to go back to December 1969, the time of the second manned moon landing, to see unemployment at levels like this. And meanwhile, wages rose 3.2% year over year in April, the same as the previous month, and the 9th straight month of 3% or better pay growth. And US stocks, which had already been climbing in Friday's pre-market trade, appeared to get a new burst of positive sentiment from the data and were solidly in the green after 2 straight days of weakness following the Fed's meeting and talks of higher inflation. The Nasdaq registered a record high close, while the S&P 500 ended just shy of a record new high. The Dow Jones Industrial Average rose 197 points, or 0.75%, to end at 26,504. The S&P 500 gained 28 points, or 0.96%, to 2,945, and the Nasdaq Composite added 127 points, or 1.58%, to 8,164. For the week, the S&P 500 and Nasdaq were up 0.2%, while the Dow slipped 0.2%. And the Fed's automatic QE unwind is continuing. In April, total assets on the Fed's balance sheet fell by $46 billion as of the balance sheet for the week ended 1st of May, which was released on Thursday afternoon. This drop reduced the assets to $3,890 billion. the lowest since November 2013. Since the beginning of the balance sheet normalization process, the Fed has shed $580 billion, and since the peak QE in January 2015, the Fed has shed $625 billion. And the Fed has now outlined its new plan for its balance sheet. In fact, April was the last month on the plan where the asset runoff proceeded on autopilot. In May, the transition begins with tapering the runoff Treasury securities while maintaining the autopilot for mortgage-backed securities for a bit longer. Later in October, a new regime kicks in that is intended to keep the balance sheet level, but replace mortgage-backed securities with shorter-dated Treasury securities, with the goal of getting rid of mortgage-backed securities entirely by even selling them outright if the runoff is too slow. And in addition, according to Fed Chair Jerome Powell, the Fed is going to decide later in the year on the details of a huge component in this new plan, how to address the maturity sinkhole that the Fed has been slipping into. Of those $2,124 billion in Treasury securities, $605 billion are bonds maturing over 10 years. Now, this amount has not moved much since the QE unwind started. So expect a barrel load of short-term bills and a fall in 10-year. Now, this could be enough to tilt the yield curves away from recessionary territory in the round, and this seems to push out any real risk of US recession for now. But the banks may be feeling it. As Fitch Ratings put it, performance for US banks in the first quarter 2019 reflect the challenges of persistently low rates, as slowing net revenue growth and margin pressure were unable to offset increased reserve bills and continued build in technology spend. While a prolonged pause in rate hikes could help increasing funding costs, yields on loans and securities will likely stay flat for the remainder of the year and into 2020, pressurizing net revenue. Their stable outlook for the US banking sector is underpinned by the view that credit quality should continue to normalize at a gradual pace for issuers. And median net charge-offs remain well below historical normalized levels, especially for commercial and industrial and commercial real estate loans. However, non-accrual loan levels for the largest US banks saw the first sequential increase in one quarter 19 since the oil downturn at the beginning of 2016, and banks have indicated that they have not seen any specific industries experiencing stress, and that downgrades were generally idiosyncratic rather than systemic. Consumer credit quality trends also showed signs of weakening, with all issuers experiencing a rise in credit card delinquencies. All of this says, be alert, but not alarmed, and expect the stock markets to continue higher in the US for now. Makes the US dollar a pretty good bet, I think. So to the Australian scene. The RBA meets on Tuesday, and there has been a growing clamour for them to cut the cash rate to help stabilise the housing market and provide some economic stimulus to an economy which is clearly not firing on all cylinders. Plus, others call for APRA to reduce their hurdle rate for new mortgage applications to below 7%, again in an attempt to stimulate lending. This is all in the context of slower lending, especially for mortgages, as the RBA data, which came out on Tuesday, showed. The headline news is that overall housing credit is up to a new record of $1.82 trillion, up 0.31% from last month, and the annualised movements by categories shows further weakness. The seasonally adjusted data from the RBA to March 2018 shows that over the last year, lending for housing rose 4%. Owner-occupied housing rose 5.7%. Investor housing rose 0.7%. Other personal finance fell 2.8%. And business lending rose 4.9%. all are sliding relative to recent months. And total credit is standing at 3.9%, and that's the lowest it's been for many years. The accompanying APRA data showed that lending from the Big Four was below the RBA numbers and that the non-banks grew faster. You can watch our show, A Weaker Credit Impulse Signals More Home Price Falls Ahead, for more. And if you subscribe to the view that credit availability is the key and the tightening by the banks is to work within responsible lending standards, whereas previously, as the Royal Commission showed, they were clearly not, we must expect more weakness. And I'm not sure that even cutting the cash rate or easing the hurdle rate for new loans a bit will be sufficient to slow the falls. The RBA has indicated it is prepared to look through lower inflation if employment remains strong, so a rate cut in the middle of an election campaign is not necessarily baked in, and a cut would be a really strong signal of economic weakness. Home price falls continued, with Domain's March quarter data showing Sydney and Melbourne and Perth are bearing the brunt of the falls, alongside units in Brisbane, according to their statistics. Hobart remains the most buoyant, but buyer interest appears to have passed its peak. And of course, remember that these are actual average figures which mask local changes. So Domain shows the year-on-year movements to March 2019 by houses and by units. Sydney houses are down 11.5% over the last year, while units on average are down 6.5%. In Melbourne, houses are down 10.4% over the last year, whilst units are down 8.3%. In Brisbane, houses are down 0.3%, whilst units are down 5.2%. In Adelaide, houses are up 2%, but units are down 1.3%. In Perth, houses are down 5.2% over the last year, while units are down 5.6% over the same period. In Hobart, houses are up 7% over the last year, and units are up 8.4%. In Canberra, houses are down 2% over the last 12 months, and units are down 1.7%. And in Darwin, houses are up 1.5% over the last 12 months, and units are down 1.7%. And the combined capital cities, houses are down 7.8% over the last year, and units are down 6.3% over the last 12 months. They say that Sydney's current property downturn is the sharpest in more than 2 decades. It is yet to surpass the duration of the 2004-06 slump, but it is coming close to being the longest. Melbourne is currently facing its steepest downturn in more than 2 decades. House prices have fallen for 5 consecutive quarters. CoreLogic's index continued to fall, and at a greater rate than previous weeks, when many in fact called the market was turning. Too soon and too fickle. Now, CoreLogic's index to the 2nd of May 2019 shows that in the last week, Sydney prices have dropped 0.2%, over the quarter 2.47%, annually 10.9%, and from the last peak 14.6%. In Melbourne, over the last week, prices fell 0.18%, over the quarter 2.23%, annually down 10%, and from the last peak 10.8%. In Brisbane, they're down 0.14% over the last week, down 1.12% over the last quarter, down 2.1% over the last year, and down 1.7% from the last peak. In Adelaide, they're up 0.08% over the last week, but down 0.31% over the last quarter, up 0.3% over the last year, and down 0.7% from their previous peak. And in Perth, over the last week they fell 0.09%, over the quarter they dropped 2.21%, annually they're down 8.20%, and from the last peak are down 18.4%. And across the major 5 cities, the weekly drop was 0.16%, the quarterly drop was down 2.10%, The annual fall was 8.80%, and from the last peak, the average is 10.30%. And to state the obvious, averages continue to mask the significant falls. For example, Gladesville houses on the Sydney Lower North Shore is showing a fall of 21.6%. And Lane Cove houses are down 18.7% over the last year on significantly lower sales volumes. North Ryde is also at 21.6%. These are big moves which will put some households into negative equity. Auction clearance rate continued in the doldrums at 50.4% nationally last week, and the volumes remains very low compared with a year back, so there is nothing here to indicate a bounce. Melbourne was at 53.6%, which was higher than Sydney's 52.4%, and that's the first time Victoria has beaten New South Wales for several weeks. And Domain also showed that the number of rental vacancies is rising, with Sydney at 3.1%, and that represents an estimated increase of 6,900 vacant rentals in the market, 2,500 of which came into the market over April. Perth was at 3.2%, and Darwin at 4.4%. So much for an undersupply of property. Rents may be falling as a result, which is a good thing for renters, but terrible news for property investors who are already seeing their capital eroding. The great property investor boom may well be over already. And data from UBS shows that the number of housing sales has collapsed by around 20% year on year to the lowest levels seen in around 23 years. And this is not a normal cyclical variation. This is a structural change thanks to tighter lending. And UBS makes the point that the fall in home sales is a very negative signal for renovations and housing-related consumption ahead. And when you couple that with a record slump in home prices, this could be a lead indicator for employment growth over the next year. And we know if unemployment and underemployment moves higher, the RBA is likely to act. And it's also worth considering the impact of slowing house transactions on state coffers. The ABS released their taxation revenue statistics for 2017-18, and the share of revenue from the states drawn from stamp duty is falling, but it still makes up 25.5% of Victoria's take and 24.3% of New South Wales. Guess what will happen if housing sales momentum continues to ease? State budgets will be in tatters. And you can see our show, Tax Take Diamonds in the Rough. So expect to see ways to entice people to transact ahead. And Western Australia and the Northern Territory are already doing this. The weakening lending environment is hitting the banks hard. With both ANZ and NAB reporting first half results this week, the common theme was weaker consumer banking performance, thanks to lower loan volumes and tighter margins. And we discussed this in our dedicated shows on ANZ, Higher Mortgage Delinquency is Now a Thing, which included a segment where CEO Shane Elliott talked about higher household stress and more households getting into difficulty. And we looked at NAB in our show More Pressure in the System as Defaults Rise and Dividends Are Cut. The clear articulation of risks building in the mortgage sector should be of no surprise to DFA followers, as mortgage stress has been building, something which we track in our monthly surveys. And the other factor in the equation is the significantly higher defaults in Western Australia. ANZ reported that WA delinquency comprises 30% of 90-day plus delinquency, despite being just 13% of their portfolio. And 65% of losses come from WA, whereas New South Wales and the ACT makes up 32% of the portfolio, but 23% of 90-day plus past due. This is because a slowing economy puts pressure on households over time as home prices and incomes fall. But the die is cast for higher defaults later, as predicted. Now the real question, as the ABC discussed on Thursday with my help, is whether we will see similar rises in the eastern states ahead.
With house prices continuing to fall, many families are struggling to pay their mortgage. The number of homeowners failing to pay their loan on time is on the rise. And experts say you only have to look to the west to see what could be in store.
For many West Australians, owning a home has become more burden than blessing. WA is about 4 to 5 times the national average of mortgage delinquencies at the moment, which is exceptionally high.
ANZ's first half results show the problem is worst in the West, where more and more homeowners are struggling to make their mortgage repayments. Data from both ANZ and NAB show mortgage delinquencies are increasing across the country, and experts warn the problem is moving east.
My concern now is that there's a contagion spreading. It's spreading across the country, and it could well hit the eastern states, particularly in Sydney and Melbourne, over the next few months and beyond.
Mr North says the number of Australians facing mortgage stress, where a household's income struggles to cover expenses, has reached an all-time high. His company's latest modelling shows more than 1 million households are now estimated to be in a stressed situation. That's just under a third of all owner-occupied properties with mortgages. Rising unemployment and household bills coupled with low wage growth isn't helping. However, it's falling property prices that's raising red flags. Last month, property prices fell in every capital city except Canberra, with Sydney and Melbourne continuing to lead the annual price declines. And it's leaving more homeowners facing the possibility of owing the bank more than their property is worth.
My own analysis suggests that households who are in mortgage stress will be able to hold on for 2 to 3 years, but at some point they will actually suddenly decide that they cannot continue.
In the meantime, mortgagees will be hanging out for the Reserve Bank to cut interest rates next week, for the first time in more than 2.5 years. Brianna Shepherd, ABC News.
I fully expect default rates to climb as the same economic effects grind on, and again small cuts in the cash rate will not be enough to reverse the trend. Only significant lifts in income will, and it's hard to see how this will occur with the current economic settings. Oh, and customer remediation costs continue to rise and are now estimated to be 10 billion plus across the industry. ANZ closed up 0.51% on Friday to 27.41, and the NAB dropped 0.12% to 25.67. And Genworth, the lender's mortgage insurer, also reported this week with continued trends in rising defaults. They reported that the delinquency rate, that's the number of delinquencies divided by policies in force, but excluding excesses of loss insurance, increased 8 basis points from 0.49% in the first quarter 18 to 0.57% in the first quarter 19. And this was driven primarily by an increase in delinquency rates year on year across all states, they said, particularly in Western Australia, New South Wales and Queensland. To a lesser extent, the decrease in policies in force resulting from new data sources secured in the first quarter 19 as part of the lapse policy initiative also led to a slight uptick in the delinquency rate. While new delinquencies were down slightly, first quarter 19 at 2,662, compared with 2,701 previously. The trend of softening cure rates, first identified in 2018, continues into the first quarter 19, with the number of cures decreasing from 2,074 to 1,998 in the first quarter of 2019. And this is because it's harder to sell in a falling market, of course. And Genworth said that they expected the moderating trend in metropolitan housing markets to continue through 2019, reflecting tighter credit conditions, weak wage growth, and increased levels of supply, particularly in parts of Sydney and Melbourne. And Perth continues to experience challenging market conditions following the end of the mining boom, and this is expected to continue through 2019. Genworth ended up 1.24% on Friday to 245, and Macquarie also reported this week with a record profit, but a slightly weaker outlook ahead. The market was not impressed, as the result was more heavily reliant on lower quality items than expected, and gains on sale and performance fees contributed 30% of net operating income, which may not be repeatable, and potentially lower commodity income ahead as they fall from current record levels. Plus, they signalled ongoing competitive pressure in the Australian mortgage book. Macquarie closed at 128.67 on Friday, down 5.52%. The HIA new home sales report for March shows that across the states, New South Wales rose 4.8%, South Australia 8.6% and Western Australia 2.3%. All experienced an increase in new home sales compared to the previous month. Queensland experienced a decrease of 4.7% and Victoria was down 2.9% on the month of February. But overall, It was another 0.1% decline, and sales volumes have been flat for 3 years now. And the ABS reported the number of dwelling approvals in Australia fell by 0.6% in March 2019 in trend terms. Now that won't help GDP or construction employment. Among the states and territories, total dwelling approvals fell in Victoria, down 3.5%, and Queensland, down 1.4%, and there were increases recorded in the ACT at 4.8%, the Northern Territory at 3.9%, Western Australia at 3.6%, and New South Wales at 0.8%, and South Australia at 0.4%. Tasmania was flat. The stronger US dollar after the Fed statement and local weakness here took the Aussie-US rate to below 70 cents at the end of the week, though at the time of writing it's back up to 70.24, which is up 0.34%. We still expect the RBA to sacrifice the Aussie to support the economy despite the inflationary pressures that will follow from that. And it's probably the strongest weapon in their toolbox, but that may not be enough, so QE may have to follow. To round out the week, gold futures for June delivery was up 0.65% to 1,280, and elsewhere in commodities trading, crude oil for delivery in June rose 0.08% to 61.86 a barrel. And finally, to Bitcoin, which ended on Friday at prices not seen for months. This has prompted commentators to start talking about a prospective bull run. Sure, despite some ugly twists along the way, including an alleged scam between Tether and crypto exchange Binifex, and over $1.2 billion lost in crypto theft in just the first 3 months of the year alone, Bitcoin has managed to withstand the pressure and remains on top. Certainly some are watching more closely now, hoping to see some more upside. Well, we'll see. And so in conclusion, the US turned stronger this week on the back of stronger economic news and the Fed's latest turn, whilst here data on housing lending, house prices, defaults and bank performance all turned weaker. And expect this tone to continue ahead. The rough ride will continue. Now the question becomes, will the RBA react? If you found this useful today, please like the post, share it, and add a comment or question. I read them all. And if you've not yet subscribed, please do so to receive future alerts or ring the bell for more specific notifications. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.